SoFi Technologies. This consumer finance company promises to transform how we conduct our transactions. The company aims to provide a simple integrated solution to help members manage their financial lives. In the last few years, SoFi has launched financial products for investing, banking, loans and credit cards. The Fintech continues to build on a suite of products leading to additional members. SoFi has reached 3.9 million customers this year from less than 1 million at the start of 2020. SoFi's dramatic collapse during the past 8 months has left its bulls in disbelief. The market price has dropped from a high of $24 to just under $5, a drop of 80%. Right now, it is trading around $6. We all made prudent investment decisions but have been totally rocked back as positive sentiment collapsed and the market crumbled. Even the future seems to be defined by a period of low economic growth and high interest rates. The recovery looks like a distant possibility. However, as the market price dropped, valuations became more attractive. In its guidance for fiscal year 2022, the company expects revenue to be $1.51 billion. At market price of $6, it now trades at a historically low price to sales multiple of 3.8 times. Not only this, SoFi's revenue is set to grow by a further 40% to $2.1 billion in 2023. The company is set to achieve EBITDA of $484 million in the same year. This would cut the multiple to 2.7 times. Earlier this year, 2 other developments happened. First, SoFi received its banking charter. This gives the company an opportunity to lower its interest expenses due to cheaper debt financing while increasing the amount of interest income it generates from loans. Second, it acquired Technicies. The acquisition of Technicies can greatly benefit the company as synergies from the buyout will help its Galileo division realize annual cost savings to the tune of $60 to $85 million. In addition, Technicies will provide additional revenue stream of $165 to $265 million to the company. According to company's website, Technicies has approximately 60 customers in 16 countries servicing more than 150 million end users, or banking customers. Galileo, meanwhile, has 100-plus partners and over 100 million enabled accounts. The combination of Galileo, Technicies, and the bank charter gives SoFi a unique and unrivaled product offering that is unmatched in the financial space. Profitability is set to become increasingly commonplace on the back of these developments. In 2018, 99.5% of SoFi's revenue came from lending, with student loans comprising 55.6% of their originations. In 2019, lending was still 98.9% of their revenue, and student loans had grown to 59.7% of originations. During that period, student loans were becoming an increasingly large piece of the SoFi lending products as well as revenue. However, COVID-19 hit and the CARES Act paused all federal student loan payments and set interest rates to zero. This moratorium on payments and interest has been extended ever since, and federal student loan borrowers have not been required to make payments for over 2 years. The student loan refinance business has decreased ever since. SoFi missed a major portion of expected revenue. However, the management did an extraordinary feat in transforming lending business from student loans to personal and home loans. At the same time, they horizontally expanded their product offerings by launching an entire range of financial products, becoming a one-stop shop for their members' financial needs. They now have the structure in place to drive business to whatever direction best suits the current environment. In this way, they have minimized the impact of absence of critical revenue from student loans. They are too busy building a robust and diversified business. Those lost dollars have been more than adequately replaced and SoFi is no longer reliant on any one product. SoFi calculates its profitability in terms of EBITDA. During the last 12 months, the firm has generated $35 million in adjusted EBITDA on revenue of $1.1 billion. This amounts to an adjusted EBITDA margin of 3%. The long-term revenue and EBITDA outlook looks very compelling and calls for significantly increased profitability in the next 3 years. If we look at the balance sheet, SoFi has strong balance sheet with $10.1 billion worth of tangible assets and $2.1 billion worth of goodwill and intangible assets. On the other hand, liabilities are $6.7 billion, which brings us to equity of $5.5 billion. Company's tangible book value stands at $3.40 per share. This brings us to the question of how to calculate fair value of SoFi. As we can see, the biggest strength of the company lies in its growth. If it manages to grow at the same pace for next 5 years, it can achieve revenue of $7 billion in year 2027. Rest of the calculations will be a little complex, but if we compare to net profit margins of Discover Financial Services and Capital One Financial, SoFi can achieve net income margins of 25 to 30%. This will bring net income to the tune of $2 billion and per share earnings of 2.2. Similarly, sales per share will be $7.60. Applying price to sales ratio of 2 times gives a fair value of $15 and price to earnings ratio of 6.5 gives a fair value of $14.30. There are other methodologies as well, like discounted cash flow and dividend discount model. Recently, the company has filed for a $1 billion mixed shelf offering. This will add dilution risk to an already battered stock price. If, for example, the management decides to offer shares worth $1 billion at a price of $8 per share, 125 million additional shares can be added that will dilute the already held 915.8 million outstanding shares. However, company will get additional $1 billion in cash which, if efficiently utilized, can increase the revenue and profitability. Another concern is the slowdown in U.S. economy can slow the growth rate of the company. In that case, investors will have to wait for the next economic growth cycle for SoFi to fully realize its economic potential. Increased competition in the fintech space can also slow down growth of the company. In any case, SoFi has tremendous long-term value as a standalone digital finance brand that could grow from a 3.9 million strong customer base to 9 million by year 2027. All in all, we can say that current drop in market price is giving good opportunity to initiate position in a growth-oriented stock with at least 200% upside potential in the coming years. Conservative investors can also sell put options for strike 2.5 in January 2024 expiry. With this strategy, 14% return can be earned and chance to buy SoFi at less than $2.20 will also exist. For those who are holding, underlying fundamentals give a sense of hope that things may improve in the next bull run. We should all remember that bull and bear market is part of the cycle which keeps changing after every few years. Therefore, a long-term perspective in the market with a portfolio of undervalued fundamentally strong stocks always wins. Join our Patreon community to get exclusive access to chat room, matchless fundamental analysis, actionable technical analysis, most profitable options trading and in-depth analysis of news and events. The link is provided in video description.